Hi, Shannon. Give me one brief moment. They've come back. All right, let's see here. We got Nastasia. Hi, Christine. Nastasia.
Hi, Bob.
Shannon, how you doing? Lauren, how's Lauren doing? Philip. There's Eric from the Inland Valley, as we used to call it. All right, I guess we're up to chapter 5. How do you all feel you're doing with debits and credits? You think you have them in your head now?
No, I'm drowning.
Accounts payable,
Help me.
Nastasia, goes up with a debit or credit.
Debit.
Oh man, you got to work on that. Stop, you're just guessing.
I'm drowning. I'm
You're
drowning.
guessing wrong. Okay, but you know what you have to do.
No, I don't. It's a problem.
Really? Come on. We worked hard the other day together, one-on-one. Come on.
You know what? I'm sorry. Can I say a sidebar? Sorry, everybody.
Sure, go right ahead.
You know what I didn't understand last night, and I felt I was really bummed I missed you in tutoring, was the general ledger really threw me for a loop. I don't know if anyone else had that problem, or maybe it's just my brain, but I could not figure out how to do the general ledger. And maybe I'll catch you tutoring next time, tomorrow.
I'll be here tonight. You know, if you want to join me this evening. Yeah, I'll be glad to go over that.
Oh, okay, cool.
Yeah, the general ledger, that's the, that's the record of the company. That's the books of the company. Okay, so we have 4 faces against 3 no faces. With 4 faces win today. All right. Chapter 5 is going to be a little challenging because we're presuming at this point you're pretty good with the debits and credits, so you're not going to fumble too much on the sign control. But what we're going to get into now, and let me share the screen. Let me share the screen. Shared, darn it. Oop, it's not there. Hold on. Share. Hold on. It's giving me a hard time for some reason. It doesn't want to share. Okay, there is the file I wish to share. It's right in front of me. Share screen. Oh, there it is. You see it now? PowerPoint?
Yeah.
Okay, thank you. Now you don't see it. Okay, let me just set it up. Slide, custom slide. All right. What we learned in the first 4 chapters was that we take a trial balance, which is simply all the ending balances in the chart of accounts in the general ledger at the end of the month. And we put them on a piece of paper where we list the debits and the credits vertically. And if they add up to equal, we said that's good enough right now. And we took that trial balance and we said that we can do the financial statements from them. What you're going to learn now, hopefully, in this chapter, excuse me, let me turn this thing off. Pete's sake. Come on, off. There we go. Sorry. What we're going to learn here is that any company that prints the trial balance at the end of the month, that trial balance is automatically wrong because it needs to be adjusted. There are certain financial transactions that can only be done after the month has ended. So if your month ended on October 31st, your accounting department might have 3 days in November to fix what's wrong with the trial balance. And that's done through what we're going to call adjusting journal entries. So on November 1, 2, 3, you're backdating everything as if you're working on the 31st to come up with the right statements. So adjusting journal entries. These adjustments are for different things. These adjustments are internal transactions, I'm going to tell you. Everything we've done so far has been with an outside party, right? Someone independent of management. We've bought supplies from somebody and then we've sold our product. We've paid the electric bill. We bought insurance. We collected cash. We paid our own employees. Okay. Here, these end of period adjustments are internal. They don't involve outside parties at all. So let me start by pointing out, we're going to do one for depreciation, equipment wearing out, prepaid insurance, and supplies. Remember those supplies that we put on the balance sheet as an asset? Now we're using them, and that's when they become an expense. And these events, by definition, have not yet been entered into the accounting system. And we're guided by the matching principle. What an important gap, generally accepted accounting procedure measure this is. Revenues and expenses must be matched in the same month when you have the activity. When you sold a product this month, the electric bill for that month better be included in the financial statements. The supplies that you used better be included in that month's financial statements. The matching principle simply means you're matching revenues and expenses on an accrual basis. The revenue recognition, we should know this already. Revenues are recognized when they're earned, regardless of when the cash is received. It's nice if it would be great if the whole world worked on cash, huh? But that's not possible. Revenues are considered earned when you sell the product or provide the service. Mitchell Williams, he delivered those pizzas. As soon as he delivered the pizza, he had revenue. He had sales in his income statement, whether he got paid or not. Same thing with expenses. They are recognized when incurred. Cash payment has nothing to do with recording the expense. And they're incurred when we get the supplies delivered to us, when we know we had electricity expense, etc. Back to the matching principle, matches revenues and expenses. By doing this, it means that the net income you're going to report at the end of the month is going to be an absolute dead-on measurement of how your company is doing. If you don't match up properly, you're going to have October wrong, and then November is going to be wrong too, because certain mistakes you make in month one impact the next month automatically the other way. Okay. So we're going to do adjusting entries. We know what a fiscal year is. It's just a 12-month period of the company's choosing, not necessarily a calendar year. And many businesses schedule their fiscal year to end when business is slow. Nordstrom's, Neiman Marcus, Macy's, Target, they're an example. They close in February, I believe, at the end of February. Their year goes from March 1st to February 28th. They're a little slower them, and they want to scoop up all those sales from the busy Christmas period. Generally, adjustments are made and financial statements are prepared at the end of a fiscal year. That's a bunch of baloney. They're done every month. Every month. I don't know any business that waits an entire year to find out if they're making money. They're done monthly. Okay, you ready for your first adjusting journal entry? Here we go. Ta-da. Remember those $80 in supplies Mitchell Williams bought? Well, maybe you don't remember, but he did. He purchased $80 of supplies. Supplies are an asset. They are an asset, and thus they were debited to the supplies account. Supplies is an asset. Normal balance of an asset is a debit, which means that $80 increased the supplies balance. Supplies is an asset with a debit balance. But we come to the end of the month. He bought those supplies maybe October, or we're doing June, I guess. He bought those supplies maybe June 3rd. Now it's the end of the month. And according to an inventory of the supplies, there's only $20 worth of supplies out there. I sent Christine out to the warehouse. Christine, count the supplies. and you came back with a very accurate count. You said there's only $20 left there, Bob. That means we used 60. We used 60. So we no longer have $80 in supplies. We only have 20. So unless an adjusting entry is made, $80 is going to show on the balance sheet, and that would be wrong. The assets would be overstated. We'd be showing too many assets. We would be understating our expenses. So to avoid that, we have to match up that expense with that month. We're going to write an adjusting journal entry. We're going to credit supplies. Supplies is the asset. We're going to credit it to reverse it, and we're going to debit supplies expense. Supplies expense. So let's take a look at the journal entry here. I assume you can all see that. Yeah. I can barely see it. Let me know if you need me to blow it up. I can do that. Look at the journal entry first. We debited the expense and we credited that asset. So the asset was $80 to begin with. If you look at the T account in the blue, the supplies were $80 at the end of the month. And then at the end of the month, we counted what was out there, and there was only $20 left. So we have to assume that we used up $60 of the supplies. So we're going to debit an expense called supplies expense, and we're going to credit the account called prepaid supplies, or as our book calls it, supplies. Your adjusting journal entries, for the most part, represent a search for unrecorded expenses and a couple revenues, but mostly expenses, okay? So these prepaid assets, we're going to credit them at the end of the month and debit the offsetting expense, okay? Same thing with the insurance, prepaid insurance. Here, they purchased an 8-month policy. Wow, look at this. They've got 8 months up here, and here they're saying it's 10 months. It's 10 months, okay? Let's work with me on this one. Prepaid insurance was $200 to begin with. He paid $700 for a 10-month policy. The coverage begins on June 1st. So we are going to debit insurance expense for 1/10 of this, which is $70. 10-month policy starting in June. We're going to debit the expense and credit the prepaid expense. Make this easy on yourselves by understanding that if we're talking prepaid insurance, the adjusting offset is going to be insurance expense. If we're talking prepaid insurance, the offset's going to be insurance expense. These adjusting entries are an attempt to locate unrecorded expenses. We can't do this until the end of the month, okay? We can't do the supplies to the end of the month because we have to know exactly what's out there. We can't do the insurance really at the end of the month because the company might buy another policy. There could be a number of insurance policies, casualty insurance, auto insurance, liability insurance. So it's best to wait until the end of the month. So here we go. Here we go. The journal entry, debit the expense, credit the prepaid. On your adjusting journal entries, you're never going to debit an asset account. You're always going to debit an expense, huh? That's pretty much true. For our purposes here, I'd like you to try to remember that. Nearly all of your adjusting journal entries are going to increase an expense with a debit, and you're going to reduce the offsetting asset. Prepaid insurance. We had a balance of 700 there. Not 200, like I said there. Balance of 700. And it's a 10-month policy. So every month for the next 7 months, or next 10 months, we're going to take out $70. At the end of June, the balance left in that policy is $630. And here's the expense. So we're picking up these unrecorded expenses, adjusting journal entries. Here's one I bet you're all familiar with. So let's talk about it. Rohan is the name of the company, I guess. Rohan paid his part-time employees $1,650 on June 27th. Okay, that represented the salary pretty much from June 1 to June 27, right? From June 1 to June 27, he processed the payroll and he got the payroll checks out to everybody and he paid them. That has already been recorded. That's fine. But since then, these workers who worked on the 28th of the month, the 29th and the 30th, that 3-day period, they earned $400. They're not going to get paid for maybe 2 more weeks. But when did they do the work? They earned that $400 on June 28, 29, and 30. So that has to be accrued via an adjusting journal entry as a June expense. Once again, we don't care when payday is. Payday has nothing to do with this. What counts is when they did the work. So we are now going to debit an expense called wages expense. It could have been salaries and wages. It could have been salaries expense. And we're going to credit an account called wages payable. So that's a new one you're seeing. There's a new liability, Anastasia, huh? A new liability that goes up with a credit balance. Liabilities have a credit balance, right? So we've seen accounts payable, notes payable, and you have wages payable. You owe these employees that money the day they earned it. If they came to you at the end of the month and quit, you have to pay them right away. You got to pony it up right away. If you fired them at the end of the month, you have to pay them that day. They don't wait for payday in that case. If you went out of business, sadly, you'd have to pay them. So it is a legitimate expense for the month. We're matching that expense up with whatever the sales were for that month. And we're recognizing a legitimate debt called wages payable. And let's look again. I'm going to take us to the journal entry first. Remember, all of your adjusting journal entries are going to debit and expense. Expenses have a debit balance. We increase them with a debit, and we reduce the assets with a credit. Here, we're debiting an expense. We're crediting a liability because that's money we owe. So wages payable was 0, and you'll learn that wages payable has to be 0 by definition when you get into the new month. So the wages payable is now 400. We owe that money. Remember the 1650 that had been paid for the period of June 1st through June 27? That money is sitting in your general ledger right here already. We're layering on the 400. So the total payroll for the month is $2,050, okay? I think we just have a couple more adjusting entries before we get into some other information here. This is super important, super important. The historical cost principle. Assets are recorded at their actual cost, and that cost remains on the books as long as the business owns the asset. You do not make any adjustments for changes in the market value of the asset. This company, you have a company, Eric, right? And you bought your grandfather started a business, and he bought 100 acres of land on the waterfront out here in Santa Barbara.
I wish.
He paid $100,000 for it, right? I remember that deal. He paid $100,000 for that land in, say, 1940. That land today is probably worth $20 million. But on your financial statement, it's going to stay at $100,000. And that's an important principle. Eric, when do you recognize the gain on that? Only when you do what with the land?
And when you sell it?
When you sell it, exactly right. Until you sell it, it sits on your financial statements at 100,000. Now, people looking at your financial statements are only going to see that 100,000, but I bet you're going to put a big, fat, juicy footnote in there that says, by the way, this $100,000 land represents 10 acres of land that has an assessed value of, 10 million. Okay. So the historic value, you don't change the value of an asset. We're going to talk about a journal entry now called depreciation expense. We're going to recognize that you go out and you buy a piece of equipment, a big machine. You buy a building. You buy a car, something that's going to last for multiple years and hopefully provide benefits. You know, the car is going to get your salesman around the country. The machine is going to stamp out your product efficiently. You are allowed to depreciate that equipment. And that is called depreciation expense. So every time you buy a piece of equipment, you have to give it a useful life. Useful life. That'll be on the test, that term, huh? Useful life. It's the period of time that an asset is expected to help produce revenues. You never know exactly how long an asset is going to last. My 1994 Cougar lasted for almost 280,000 miles, which I thought was pretty good. Here, the useful life that you assign has to be reasonable. The term in accounting is you come up with the life on a systematic and rational basis. For example, you buy a giant truck. You paid $100,000 for the truck, and you figure that truck's going to go 400,000 miles before you have to get rid of it. Well, you can't say we're going to have a useful life of just 1 year because I want all that depreciation expense in the first year and thus reduce my net income and my taxes. No, it has to be reasonable, okay? Expenses are recognized and the value of the asset is going to be reduced through the net book value, which we'll see shortly. So here we are, depreciation expense. Depreciation expense. I kid students all the time. This is the journal entry you pray they put on the exam because it's always the same. It's always a debit to depreciation expense and a credit to accumulated depreciation. Depreciation is an expense. Accumulated depreciation is what's called a contra asset. Remember, drawing is part of equity, but drawing had a debit balance. This is the same thing. We are never going to credit the original cost of that truck. We paid $100,000 for that truck. That truck is going to sit there forever at $100,000, but we're going to reduce the value of it every year by debiting depreciation expense and crediting the contra account, which is called accumulated depreciation. Contra accounts are married to somebody. Just like drawing was married to your capital account, accumulated depreciation is married to the original cost. Here's an important concept as well. And you can see this chapter throws quite a bit at us, huh? Salvage value, scrap value, residual value. It all means the same thing. Scrap value. What we expect somebody to give us for this asset when its life is ended. When this asset has been deemed done. The life of the asset is over. We're not going to use this asset anymore, probably. We must estimate how much someone would pay us for it. So that $100,000 truck, you know, over the next 10 years, we're going to beat the heck out of that truck. And after 10 years, it's going to be a hunk of junk. We'll barely keep it running. But I bet a junk dealer would come in here and give us $5,000 for it, maybe, you know, for the parts, for the glass, whatever. So we have to estimate that. And the reason salvage value is so important is it plays a role in the depreciation expense adjusting journal entry. You don't depreciate salvage value. Here we go. There are many, many, many types of depreciation methods that companies can choose. Your book says most use straight line, and I think that might be right because that's the easiest, okay? And that's what we're going to learn here. Remember, Mitch bought motor scooters. Well, he thinks those motor scooters are going to last 5 years, and he paid $4,800 for them. and there's no salvage value. In other words, he thinks when after 5 years, the only thing he can do with those scooters is put them in a landfill. Okay. Because salvage value is zero, the whole 4,800 is going to be depreciated over 5 years. Assume a full month's depreciation is recognized each month. So 4,800 divided by 60 months, right? It's a 5-year deal, 5 years times 12. 4,800 divided by 60 is $80 a month. That means for the next 60 months, we're going to make the same adjusting journal entry on this piece of equipment. We're going to debit depreciation expense, and we're going to credit accumulated depreciation. The difference between the original cost of the asset and the accumulated depreciation is called the net book value, the book value. Book value, original cost of plant assets minus accumulated depreciation gives you the net book value, or if it's easier for you, think of it as the undepreciated amount of the asset. Also keep in mind that the value of the asset we have on our books, just like that land that Eric's grandfather bought, that machine does not represent the market value. Where I worked for most of my career with downtown Los Angeles, and part of the operation was an old printing operation. We printed electrical wire markers and things, but we also had the old-fashioned linotype machine, linotype. We actually had a machine that melted lead, and then the melted lead would go into a mold, and then the mold would cool, and you'd peel it off, and then you would put ink on it, and nobody uses that. You know who used it, though, for a while? Hollywood. If you ever watch a Western in black and white, you see those wanted posters? We had the ability to make those to great effect. I have a feeling that machine is worth zero now with the internet, with graphic arts. But anyway, book value, asset cost minus the accumulated depreciation. Accumulated depreciation. Contra, from the Spanish word meaning contra, It's a contra asset, the opposite of the normal sign control, okay? Has a credit balance. You're going to deduct it from the original cost. So look at our journal entry. Debit depreciation expense, credit accumulated depreciation. Those two accounts are always the same. It's always a debit to depreciation expense and a credit to accumulated depreciation. So let's take a look here. See our journal entry, debit depreciation expense, credit accumulated depreciation. You notice they're not putting explanations down like I said we should. They really should be making you do that. We should be able to say to record depreciation on that. So look at over here on the red side. There is your depreciation expense, $80. Accumulated depreciation is 80. What was the original cost of the equipment? $4,800, right? Well, it's now 4,800 minus 80 gives you $4,720. That's the net book value. The next month, we're going to see the same thing happen. And we're going to see this go from 80 to 160, 80, 80, 80 every month until it equals the 4,800. And at that point, this asset is fully depreciated. That doesn't mean we're going to throw it away, though. We may have taken such good care of it that it lasts beyond what the useful life was thought to be, but that's fine. That's not a problem. Companies love depreciation expense entries. Hey, Christine, can I ask you a question? Why do companies love depreciation expense as a transaction, you think? They love it.
Because they're, It looks better on the reports for some reason, so it's
Yeah.
less taxable. I don't know.
There you go. You hit it right on the head. I was waiting for you to get
Something
there.
like that.
Yeah, good, very good, Christine. Put Christine on the spot. Yeah, this entry has no cash involved.
Yeah.
There's no cash involved. But what does it do? It reduces your net income by $80. Let's assume this is a big company and that's $8 million. Well, at 30%, that company just saved $2,400,000 in taxes. So companies love depreciation expense. They love it. And they're just showing you some of the new accounts that they just introduced. For the first time, you're seeing accumulated depreciation and wages payable, and 3 more expenses you hadn't seen before: supplies, insurance, and depreciation expense. Would you believe those are all the adjusting journal entries? That's all you need. I don't want to say that's all you need, because it will be a little confusing at first, but those are the adjusting journal entries. Now we have to post them to the general ledger. Now we have to post them. You wrote all those entries and you're looking at them and you say, I think all these adjusting journal entries are correct. What do you think? And then the whole accounting department go, yeah, let's post it. You post. As soon as you post them, you affect the general ledger. So take a look at the general ledger here for supplies. Supplies had a balance of 80 at the beginning. They're not showing that, unfortunately, but that's okay. They're showing us the debit to supplies expense and the balance of $60. Okay. Let me blow this up, because if you guys can read this, I'll be shocked. Look at the posting, please. The first entry on the upper left, we debited supplies expense and we credited supplies. Here are your supplies expense has a debit balance there after you debited $60. It was 0 to begin with. You debited 60. Therefore, the balance in that account is now $60. That's all the general ledger is. It's just a fancy pair of T accounts, one for the transaction, one for the just to show the running balance. Look at your asset. Remember, we bought $80 worth of supplies. We counted 20 at the end of the month. So that means we used 60. So the balance has gone from 80 down to 20. Let's take a look at a couple others. Oops, going too fast. Same thing with the prepaid insurance. The prepaid insurance is the asset. That asset we know is going to go down $70 a month. $70 a month. Well, we know that our adjusting journal entries are all debits to an expense. All debits to an expense until later. For now, all your adjusting entries are debits to an expense and a credit, possibly to a prepaid account. We had a policy of 700 and we reduced it by 70. The balance is now 630. Next month, we're going to see another 70 here, and the balance will go down to 560, etc., until we use up the whole 700. Okay, let me keep going here. And I guess they're showing the other two, and I'm glad they are. Zooming the modern way. Okay, do we understand this entry here? This is, you guys, you're all working people. I know you're all out, have been out in the workforce. You're probably all working right now. Yeah, you made money the last 3 days of the month. That company owes that money to you at the end of the day. Legally, I guess you can go to your boss and say, listen, I decided that I don't want to wait 2 weeks for my paycheck. From now on, I want you to pay me every day. And the boss said, okay, is that what you want to do? And you say, yeah. And the boss says, hold on. And he'll hand you your last payroll check that day. You won't be with the company anymore. Because when you joined the company, you agreed to their policies. You signed off a couple of things that said, I agree to wait for my paycheck. But legally, they do owe it to you, but they're not going to pay you like that. So wages expense, we debit wages expense, up it with a debit, $400. And here's our credit for 400. Remember the 1650, that was the total of the salaries worked from June 1st till June 27th, minus last month's accrual, okay? And then let's look at our final one, our final depreciation expense. Debit depreciation expense, credit accumulated depreciation. Excuse me. Look at those balances. It just so happens it just so happens it's a brand new machine. So they didn't have a balance to begin with. We debit the expense and we credit the contra account. 4,800 was the amount we paid for that machine. And the difference of 4,880 is 4,720. And that's going to go down by 80 every month. Now, how do we organize this information? Well, we had a balance sheet. I'm sorry, we had a trial balance, right? We had a trial balance that we worked with at the end of chapter 4, and that worked easily. But now we know those numbers are incomplete. I don't want to say wrong. They're by definition incomplete because they lacked the adjusting journal entries, which we're preparing now. So the best way to handle this, I bet, is with some kind of worksheet. It's going to be a long worksheet, actually, when we get through with it. But let's take a peek. The worksheet, it's really an Excel spreadsheet. Let's think of it that way. It pulls together all the information we need. It's going to let us enter the adjusting entries. And it's not a financial statement. It's just a worksheet, just an Excel spreadsheet. It's just for accounting purposes. No one's going to want to see your worksheet. Ordinarily, only the accountants use the worksheet. And it'll be in a 10-column format. So let's take a look at it, okay? 5 steps. And I don't expect you to write these down or memorize them at all. You'll know them by doing them. Yeah, the first thing we need to do is prepare the trial balance. And we've learned to do that. That's what we learned through chapter 4. Then we prepare the adjusting entries. And then we're going to take that beginning trial balance and we're going to debit or credit the adjusting entries to come up with a new trial balance. And then once we have the new trial balance, we can prepare our financial statements, huh? So let's see what we're talking about. They're talking about a heading on this thing. I wouldn't worry about that. It's an internal thing. But yeah, I guess you put the company down, call it the closing worksheet or something, and you prepare the trial balance. This is the same trial balance from chapter 3. And now we're presenting it again here. Prepare the trial balance. We should know how to do the trial balance. Prepare the adjustments. Record the adjustments. And you're going to see a column next to the trial balance that says adjustments. And then you're going to see a third pair of columns that says adjusted trial balance. Adjusted trial balance. That trial balance that we prepared in chapter 3 and 4, think of it as a preliminary. Preliminary. We got to get to the main event. So let's take a look at this worksheet. Wow, look at this, huh? That's a big thing, huh? But let's divide and conquer, okay? Starting with the yellow, that's your trial balance. This is the same trial balance you did when you prepared your homework and your lessons in class. Remember, we had the famous, I have the numbers memorized for Pete's sake. Remember, we had 470 in cash and 3,100 here, and etc. But now we have to prepare our adjusting journal entries. Our adjusting journal entries. And it looks like we had 4. We just did 4, right? Let's just go back real quick. We'll keep it here for a second. Let's find out what happened. Well, let's start with A. You notice they have a letter next to each of the numbers? That's to keep track of what you're doing. So let's find the debit A. It's got to be a debit A, huh? And look at this. Here it is. Remember the $60 of supplies we used, Nastasia? We used those supplies, right?
Mhm.
That's an expense. So that goes there as a debit, and we're going to credit the supplies, 60. So the balance is now $20 here. Let's find the B debit. Same type of thing here. $70 insurance expense means that we consumed 70 of the $700, so that's a credit. C, we recorded $400 in wages that you guys earned the last 3 days of the month, but has not yet been recorded or paid by the company. So we recognize that expense, 400, and we recognize that we owe the money, which we do. We owe it legally and on a GAAP basis. And then finally, the depreciation expense, the one that companies like. We're debiting depreciation expense to show the wear and tear on that equipment. Debit the expense, and you credit the contra account called accumulated depreciation. The difference between the 4,800, the original cost of the equipment, minus the accumulated depreciation is your net book value. Okay. Anybody have any questions? Am I going too fast? Anybody have anything? Okay. I'll assume we can just keep going. What we're going to do now is we're going to take this trial balance, which we're going to call the preliminary or incorrect or incomplete, the preliminary trial balance. We're going to add and we're going to debit and credit these entries and come up with the new finished trial balance. Prepare the adjusted trial balance. Well, we've already done the hard part. We've done the hard part. Preparing the journal entries is the hard part. Posting them, writing them into the worksheet should be pretty easy. Debiting and crediting to the new numbers should not be too tough. And then once we have the new trial balance, we all know how to do the financial statements. So we're going to prepare the adjusted trial balance. Extend those debits and credits that are not adjusted directly to the adjusted column. If an account has a debit and credit, you subtract. If an account has two debits, you add. Just depends. And they're talking about double lines and single lines. I'll let you run your imagination wild how you like to use the lines, okay? So let's take a look at the worksheet. Whoa. The worksheet. Here we go. Let's take a look. Let's start at cash. What was the balance in cash at the end of the month? $470. You are never going to adjust cash or accounts receivable, okay? I'm not going to send Philip out to the safe at the end of the month and count the money. And he comes back, we don't have $470,000 there, Bob. We only have $450,000. I said, okay, we'll adjust it. No, cash is something you need to know to the penny. Same thing with accounts receivable. Supplies, well, that's a different story. We're using these things every day during the month, but we're not recording them till month end. Supplies, the asset was 80. We used 60. Here's your new balance of $20. That's all you do. Delivery equipment. We know we're never going to change that 4,800, so we just bring the 4,800 over, like we did with the cash and the receivables. Here's the accumulated depreciation. Happen to have no beginning balance. We credited 80. That means we have a credit balance here of 80. Wages payable. No balance to begin with. We credited 400. That's the money we owe for those last 3 days. Capital and drawing, you're never going to adjust those. You're going to adjust expenses like crazy though, huh? Wages expense, it was $1,650 plus 400. It's now $2,050. Rent, you don't have to do any adjusting for rent. Just bring it over. Supplies expense, that's a debit balance, becomes a debit balance, phone expense, etc. It's not too tough, I don't think. It's overwhelming though, I guess, when you first look at it, right? Oh my goodness, all these columns here. What am I supposed to do with this? Keep in mind that you want things to balance, right? The first 6 columns, the debits better equal the credits, okay? So that's a look at how we get from the preliminary trial balance to the final one. They're calling it the adjusted trial balance. I like that word. I agree. The adjusted trial balance. Now we're going to use that adjusted trial balance to do the income statement and the balance sheet. And remember my tip? Remember I said everything below drawing is income statement. Everything above is balance sheet. Make it nice and easy. I would never give you a problem with the trial balance out of balance. Other teachers like to do that to make it harder, but I think that's counterproductive, really. More discouraging. Okay, now we're ready to do the income statement and the balance sheet. We're going to extend all the revenues and expenses over and have some fun with that. Let's take a look. Wow, look at all this. Step 5, don't worry about this. Rule, you're talking about using the ruler or whatever. And I'll explain the bottom part about adding the net income. I think I can do it much more clearly with a visual here, okay? So let me zooming, okay? All right. We now have an adjusted trial balance right here. We have an adjusted trial balance. And what did I say? Everything below drawing is your income statement. So you just bring it over. Don't make this mistake, which is easy to make. You go through all this work to come up with an adjusted trial balance, and then you go back and use these numbers by mistake. These numbers are no good anymore. This is the new adjusted trial balance. It's very easy to do if you're careless or you're going too fast. And I do that once in a while. Okay. Delivery fees, 8,000, and look at your expenses. Look at your expenses. Look at the total on the bottom. It doesn't balance. Good gosh, it doesn't balance. That's good. We don't want it to balance. We want to see a higher number on the credit side because this represents the sales. The difference between the 8,000 and the 3,360 number-wise is $4,640. That represents your net income. Your net income. You got the income statement right there. Your net income. So all we're going to do is take that number 4640 and add it to the 3360 just so we balance these two columns, okay? Now, if we've done things correctly, we should be off by the same amount of 4640 when we get to the balance sheet. And we are. We brought everything over from here and we added them down. And look, we had to plug a debit here. Here it's a credit. It's good that it's a credit because it's going to be a credit to capital at the end of the month. We're going to take that net, we're going to take that $5,000 in this 5,000 here, everybody, is your capital. We're going to take that 5,000. We're going to add the 4640 to it, your net income, and we're going to subtract the 3 to get the new equity amount. And we're doing the same thing here. You take the lower number and add the difference to it. What do you think? What do you think, Philip? Any thoughts so far? Are you keeping up with us?
I'm keeping it up.
Yeah.
I'm doing good.
Yeah, a little at a time. Divide and conquer. You know, this sheet is pretty big. I used to like doing this, by the way, when we had to do it in pencil. I used to like, I don't know why I was a nerd. I was a super nerd. I used to like to take that big long accounting paper and put it on a conference room desk. We had room, and you do it in pencil. And Of course, it was not fun when it didn't balance and I had to work till midnight, but that's a long time ago. And they talk about finding errors. We already went over this. The only thing, the rule at 9, you got two, you're working in Excel and you're entering 2 rows of numbers and they're supposed to equal and they don't. See if the difference is divisible by 9. If it is, then it might be a simple matter, just quickly running your finger down and seeing where you transpose the number. Okay, so we have now finished the worksheet. Now we can prepare our financials, journalizing, adjusting entries. I thought we already did that. The worksheet, maybe. Okay, here we go. I'm going to make this a little bit bigger. Okay, let's see what we have here. Wow, a lot of color coding, huh? They're just using those codes to match up the journal entries. But let's take a look. Well, we know we had a profit of X amount of dollars. So those are the adjustments. Oh, okay. They're just showing you the journal entries. That's what we've been talking about the entire chapter, right? We debit the supplies expense. We've seen this already. Debit the insurance expense, credit the prepaid. So it looks like you've got 4 adjusting journal entries to worry about. 1 for insurance, 1 for supplies, 1 for wages, and 1 for depreciation expense. Read the problem carefully. They like to see if they can mess with your mind. Remember this problem here? They said that we counted at the end of the month 20, right? We counted 20 and we had 80 to begin with in supplies. Therefore, we use 60. Sometimes they mess with your mind. They'll say, we used 60 and you don't have to do anything other than use the number. So sometimes they give you the ending balance and sometimes they give you the actual expense. And that can be very frustrating if you misread that, which is rather easy to do. Okay, explain the cash, modified cash, and accrual cash. No, I'm not going to do that. We do accrual-based accounting. Can you remember that word? Accrual. Accrual. An accrual means that we roll up, we accrue, we gather our costs in the proper fiscal period according to GAAP. We don't do anything on a cash basis. If you do things on a cash basis, that might be fine for your tiny little business. But if you're doing things on a cash basis, you're never going to be able to go to a bank and borrow money. No one's going to invest in your company because cash basis totally throws out of whack the matching principle we talked about. You're never going to know if you're making money or not in a particular month. It'll lead you to bad decisions. Cash basis is strictly for real tiny things. My brother-in-law back in New Jersey, he's an Italian guy, if you get my drift here. Anyway, his family owns a couple of pizzerias. They own auto parts stores. And I was kidding him. I kid him a little bit. I say, hey, Artie, how much money do you make running that store? He said, it depends. I said, what does it depend on? He says, well, at the end of the week, we just scoop up what's ever in the cash register and split it up, basically. I said, how could you do that? I said, doesn't that foul you up if you have to borrow money? He said, we never borrow money, you know? All we do is have an accounting guy come in a couple times a month and make sure we're recording things right. He does the taxes for us. If that was a bigger company, they'd be out of business in no time. Accrual basis. Accrual basis means revenues and expenses are recorded when incurred. You recognize payables and receivables. Under cash basis, you wouldn't have any receivables. Modified cash, depreciation methods. I'm just going to show you, Cornelia, this is the appendix. We're not going to go into this in detail, nor will this be on the test, except possibly for one thing that I'm going to show you here. There's a method of depreciation called double declining balance. Now, when you get into 230, they'll teach you all these things. Double declining balance. Cornelia would like me to talk about that, okay? Double declining balance. Double declining balance means double the straight line rate. We had a machine that had a life of 5 years, right? 5 years. That's 1/5. Would you agree? 5 years, 1/5 each year. That's 20%. 1/5 is 20%. Double declining balance means you take the double of that. So if it was 20%, we're going to say 40%. And we're going to depreciate 40% each year. And I just want to show it to you visually, I hope. And then we'll be done for today, okay? So take a look at this. I just want you to understand the concept and understand that companies can strategically choose their depreciation methods to manipulate legally and according to GAAP their year-to-year reporting. So this company bought something for $40,000, right? 5 years. That's 20% a year, right? 1 year over 5. Multiply it by 2. They're going to record $40,000 times 40% the first year. So look at the depreciation expense the first year. $16,000. $16,000. So 40 minus 16 brings the net book value down to 24,000. The second year, 24 times 40, it's only 9,600 in depreciation expense. We subtract that from the 24, we get the 14,400, etc. So what are they doing here? They're front loading most of the depreciation expense. They're front loading it. This company has chosen a method where they're going to show a ton of depreciation expense in the first couple of years, knowing in future years the number is going to go down. And that's kind of what I wanted to show you. Straight line, everything is the same each month, very smooth. Double declining balance. Here's an opportunity to manipulate things a little bit. They bought this machine and they were deciding, well, how do we want to depreciate this? And someone said, we're having a pretty good year. Our profit's going to be $100,000. And the boss said, gee, that's going to cost us $30,000 in taxes. And then someone has this idea. Let's front load the depreciation expense 16, and we'll save 30% of that, $5,000 or so. Okay. And that's pretty much our chapter. Anybody have any comments, any questions, anything you'd like me to go over again? Any baseball fans here?
Oh, hell yeah, Dodgers.
Did you see that horrendous play in the Pirate game yesterday? What's
Yeah,
that?
Pittsburgh and Chicago.
Have you ever seen anything like that in your life?
Nope, and I used to play baseball all the way through senior year in high school, and I've never seen any crap like that.
For you non-baseball fans, the first baseman was not smart enough to take the throw and step on first base to end the inning. I'm probably going to have to trim this out of the video now. Cornelia's going to be mad at me for talking baseball. All right, so you know what I'm talking about. Okay,
Yeah.
I guess we'll call it a meeting then, huh?
Sounds good.
Okay. Hey, hope to see you some tonight. I'm tutoring tonight, Natasha, if you want to join me.
Sounds good, Bob. Is it at 5?
5 o'clock it is. I
Okay.
usually get there early. I'm usually there about 4:59 and a half, okay? Okay, we'll see you later.
Thank
Hey.
you.
Bye.
Bye-bye, all.
Bye.
Bye.
There it goes.
Like the Waltons.
I have a question. If I have a question before the 5 o'clock, can I email you? Or is it
Of course,
only at 5?
You can text me if you like, yeah.
Oh, okay. What is your text number?
805.
Hold on one sec. Let me grab it. I have a million pieces of paper. Let me get it.
I didn't see you in the queue here. You were hidden from me.
Oh, I was there. Can you see me now?
Oh, yeah, now I see you.
I was at the top.
I never went around looking on my.
Okay. Bob.
Yeah, 805 452-4883.
Okay, do you have a second now?
Yeah, of course, of course.
Okay. Can you share your screen with me?
You mean, you want to share with me, you mean, right?
That's shoot. Now I'm gonna be late for something. Can I reach out to you later today?
Yeah, yeah. I mean, I'm
I
here.
I have to be somewhere at 1:15.
Yeah,
Yeah, I just have a couple little assignments where I wasn't sure what they were asking for.
Is that with the
and-
posting reference by any chance?
No.
Okay, all right, because
No,
everybody
it
was
was
asking
like-
about that.
Chapter 2, didn't know what they were talking about. And then
Okay,
something about categories like an apple or fruit or something like that.
okay.
And,
Okay.
so I never did that one. And then there was one other thing I can't remember, but I could look through my modules and figure it out.
Okay, yeah, I have to run out for about 3 hours, but yeah, you text me and I'll get back to you as soon as I can.
Awesome. Thank you. I appreciate it.
Okay, we'll see you later, Mike.
Have a super great day. Bye.
You too. Bye-bye.